Hope everyone out there has had a great start to their week. It is Monday, December 2nd, 2024, and it is time to kick off this episode of Navigating the Markets with me, Markets and Mayhem. So no presentation would be complete without our risk disclosure. All trades and investments involve the risk of financial loss. The value of positions can go down as well as up. Past performance does not guarantee or predict future results. So let's get to our market overview here. Today's heat map showed a rally that was pretty concentrated in tech. We can see that with the components that were pretty lit up green, and this is actually kind of festive, all this red and green on the heat map. But in all seriousness, it does show us that there's a lot of enthusiasm coming back into some of these tech stocks after we had seen some of the older economy stocks start to outperform. Some of this is likely just position shifting as we get into the end of the year, but it will be interesting to see if this flow is durable. And certainly there are some reasons to look at the NASDAQ just a little bit more closely here, and we'll get into those in just a little bit. First, we can see S&P remains in a healthy uptrend, setting a new all-time closing high today, and overall continuing to look pretty constructive in terms of how it's been trading in terms of the low volatility environment that we are currently in. So watching S&P today up just 0.25%, but I think the bigger picture takeaway is that it was able to register another all-time high and pull further away from that magnet at S&P 6,000. And we're starting to see some other signs that I'll get into in just a moment that this could have some legs. The next one is the chart of the NASDAQ, getting close to putting in a new all-time closing high here. Not quite there yet, however. So we're going to be watching this. There are, again, some signs underneath the surface in the NASDAQ that we'll get into that look promising, so we'll be paying attention to that. But first, back to the S&P 500 cash index, we can see options positions are rolling higher. Those 6050s, 6100s, and 6200s getting a lot of attention over the last couple of trading days. And this is larger trading desks giving us their vote of confidence. And it's looking pretty good overall. So I do think it's just a sign that the broader market is telling us, you know, there is some room higher. We do have confidence in rolling these positions. We saw this rolling only really start to take shape recently. So I think that's also something to take note of, is that this is a more recent development. Before 6,000 was kind of like the level. There wasn't a lot of positioning coming above that. And it's something to just take into consideration, because a lot of the larger desks out there are looking at this and saying, okay, you know what? We've got a little FOMO. We want to chase this as we get into year end. And, you know, it's hard to blame them. I mean, a lot of these guys, a lot of the managed money and folks out there that are, you know, in this environment have been missing this performance. And so now they're in that chase mode, feeling like they have to kind of catch up to what's happened in this market so far. So that's something to keep an eye on as we get through the rest of this year. I think we could still have a little bit more of that chase mode. But for now, we're going to be watching this just from the viewpoint of 6,200, 6,300 by end of year. Not terribly unlikely in the S&P. That is to say, there's no reason we can't move up, you know, maybe another 5 to 7% from here with end of season flows, with some of the constructive elements of buybacks and just a lot of this sort of chasing of performance and window dressing we'll see towards year end. Now, zooming in to the market with an eye on options, we've got the December S&P 500 futures contract on screen. And part of the market prep I shared on the Traderade Discord pointed to the idea that it is somewhat likely we'd see some resistance at these two levels, key 2 and key 1, which is SPX 6050 and SPX 6100. And indeed, today, that SPX 6050 level was a key area of resistance. We did see some selling take place just around there, and it makes sense. You've got folks that are looking at that. They're going to either take some of those positions off and roll them higher, or at least probably cash in. And that's one of the reasons those larger even number option strikes, where positions start to get pretty big there. And this is the second largest level of key call positioning on the chain. That gives us a little bit of a sense that it can be a short-term ceiling. That doesn't mean we can't push higher. What it means is that we want to continue to pay attention to those intraday flows. Today, as I shared on social and on the Discord, 6050 SPX was the most active call by a lot. That was the most active strike on the chain, and that's exactly where we were pinned into the end of the day. And that's no coincidence. Options really are the tail wagging the dog. They are the magnet that leads price around. So paying attention to those flows has been a big advantage for us on the Discord. And the order book for the S&P 500 does still remain somewhat illiquid in its total depth. This is a bit of an issue because it does provoke episodes of greater realized volatility if there's a powerful event volatility catalyst. So for us, if we're day trading, that means smaller position size. It means wider stops to take account of that less liquid order book. And it also means being a little more discerning with what trades we're willing to take on. We're certainly not as illiquid as we were during some of these episodes like early September or over the summer or what we saw during early June. But nevertheless, it is a little less liquid than I like to see. This is a little bit more normalized levels of liquidity. Typically, it thins out over summer and then comes back in fall, but we haven't really had that depth come back. So it just has my radar up a little bit in terms of how we treat the market intraday, whether we're trading S&P futures or even single stocks and ETFs. This lack of liquidity and greater influence by options has an impact on price discovery. Now, this is also a market that is relatively well hedged. We do see a reasonably large amount of options positioning here, and that's a good thing. That just gives us a sense that if we did have a risk-off catalyst, there are some buffers, there are some breaks. The runway is somewhat foamed, you could say. And I think that's important when taking into consideration, how things could go otherwise. Like if you had a poorly hedged market and a negative event volatility catalyst, you could have a more powerful downward move that would fatten that left tail. Now, there are other things to be concerned about in terms of that left tail risk, but at least here, hedging is not one of them. Moving right along, one thing I'm also paying attention to is the New York Stock Exchange new highs versus new lows. We can see it's really been pretty solid for the past several months, just new high after new high after new high in excess of new lows. Very few days in aggregate where new lows were outpacing new highs. This is a diametrically different picture than we see in the NASDAQ. But before we get to that, it is starting to look like the New York Stock Exchange is getting a little bit stretched. This is a chart I've been sharing for several years. The number of number of stocks, I should say, above their 20-day simple moving average. And I do this on a weekly rolling basis for both the New York Stock Exchange and the NASDAQ to get a sense as to how stretched they may be. Often above 70%, you have a higher chance of some kind of consolidation or a corrective impulse, or maybe, some sell down, basically. So right now we're clocking in about 72.90. That just tells me we're a little stretched. It's nothing extreme. There's no need to be alarmed by it, but it does tell us that, the left tail in the New York Stock Exchange is just a little bit fatter than we would like to see. It wouldn't be a good time to get aggressively long some of these stocks. It would be a good time to maybe lighten up, maybe hedge out some positioning, especially within this area of the market. Now, the contrast between the new highs versus new lows in the New York Stock Exchange versus the NASDAQ is pretty dramatic. There's been a lot of days on the NASDAQ where there were more new lows than new highs. And that August 5th sell-off, wow, that was quite an alarming spike lower. Lots of new lows made that day, about 500 versus new highs. But things have gotten quite a bit better recently. You've seen some days with some very powerful thrusts higher with new highs versus new lows. 3 of them in the last, let's call it month, that have been well in excess of 400 new highs versus new lows. So that's a really positive expansion on the NASDAQ. The other thing that I like to see on the NASDAQ is it doesn't look stretched like the New York Stock Exchange. So it gives me a sense that maybe some of these components, and I have my eye on one area in particular that I'll share with you later on in the presentation, but some of these components look attractive here for continuation. Now, let's shift gears a little bit and talk a little bit about flows and positioning and a dash of sentiment. First, we have U.S. exceptionalism and flows. This is a chart from Bank of America that they shared recently. And you can see that since the great financial crisis, flows into the U.S. have been close to 1.1 trillion versus flows into Europe, Japan, and emerging markets combined have been less than $250 billion. So this is really an area that explains some of what we're seeing, especially lately. Look at that divergence between emerging markets in Europe and the United States, just pretty dramatic. Everyone wants to get long U.S. equity, and they're lightening up positions in some of these other areas. Now, will this lead to opportunities in the future? I think it will, but in the purpose of what we're trying to talk about today, I have some very particular areas that I'm looking at that I think could be beneficiaries. So even though it looks a little bit wild, it actually leads me to believe that there are some areas where we can make money here. The other thing that has me a little bit interested, a little bit curious, and slightly concerned is just record 4-week flows into U.S. equities. There's never been this much flow over such a short period of time. So the last time we saw something close to this, we could say it was probably around early 2021 in the first quarter of that year when there was palpable euphoria in the markets. You could say we're seeing some of that this time around as well. And it's pretty powerful. We also can see that retail, us, these folks at home that are trading stocks and investing in stocks and have retirements and so forth, 56.4% expect equities to be higher in the coming year. That's a record. There's never been a reading this high in the Conference Board survey's history. So that's a little bit of palpable euphoria as well. It doesn't mean things are going to end tomorrow. It just means people are feeling really good about 2025 right now. Citigroup also has a market sentiment indicator that is off the charts euphoric. Credit to Milk, one of our Discord members, for sharing this chart in the commentary room before. This one comes from Citigroup Investment Research, and we can see this is the highest reading we've had on the chart or over the last 1-year sample period. So people, again, feeling really good about this market. So good that they're piling into leveraged ETFs just about everywhere that they can. And this is weekly traded value. So we're now back to levels of leveraged ETF speculation that we were seeing last in 2022 and maybe a bit early 2023. But this time, a lot of this flow is into the long side of these ETFs. And not only are the flows setting records, but so are the number of billions of dollars in AUM or assets under management within these leveraged ETFs. So again, just a little bit of palpable euphoria here. People are putting on more leverage. They're, as a result, taking on bigger bets, and a lot of those bets are looking for upside. So it's something to keep in the back of our mind as we talk about the big picture and then the opportunities. Last but not least, though, in positioning, NAAIM registering a high. We have not seen a level this high since July 3rd, 2024. So the NAAIM survey is a survey of managed money, and they're asking them about their long positioning, their short positioning, and basically getting an aggregate that gives us a sense as to just how long they are. The last reading came in at 98.93. The July 3rd reading was 103.66. So we're getting close to those really stretched summer sentiment levels that we saw earlier this year. Adding to that, the NAAIM average in quarter 3 was just 80.82, which was similar to the Q2 average, giving you a sense that we're getting a bit stretched versus the averages as well. Goldman also has a sentiment indicator. It's reading 2.3 right now. That's the highest reading in over a year. So just overall, lots of people feeling really good about the market. The reason I mention this is because it means if we do have a risk-off catalyst that's powerful, it fattens the tail, right? You could see more selling pressure if there was a reason for it. Doesn't mean we're automatically going to have that happen, but it's something we need to keep in the back of our minds as we manage risk and potentially hedge some of our positions. So let's talk a little bit about the big picture, and then we'll get into some of the opportunities I see ahead. And if you're not able to catch this whole thing, the recording will be posted shortly thereafter. First, the S&P 500 is trading at the 4th highest trailing PE in the past 124 years. Higher occasions were July 2020 or June 2021, June 1999 to December 1921. Now, why does this matter? Well, let's break it down, because it's not everything is expensive. That's not what this chart says. Now, if you looked at this chart in isolation and you said, boy, the market sure looks expensive, it would be a little deceptive, because the reality is it's mostly the top 10 largest stocks that are pulling this valuation much higher. And if we look at the other 490, well, I would say it's reasonable to think there's actually areas of opportunity in there. And we'll talk about that just a little bit later on. But this is a really interesting dichotomy, because it suggests that these very large areas, these very large companies, have not only become an incredibly concentrated part of the market exposure. I think it's about 35% of the S&P weighting is just in 10 companies, but we're also seeing their growth slow. Yet in the other 490, we're actually seeing their growth improve and their relative valuation is more attractive. So again, setting up for opportunities. We've been talking about this since summer. One of the trades we talked about and put on was long RSP, the equal weight S&P. That is one of the ideas I have to share again tonight, but there are more that I think will be money makers as well. Next up, we have, let's hope there is no inflation. So people really don't think that inflation will be a concern. If it is a concern, a lot of folks aren't really positioned for it. And it does kind of feed into some of my ideas there, where we are looking at some of the opportunities in the market, because inflation isn't universally bad for every asset. In fact, inflation suggests prices are going up and earnings are measured in nominal terms, so inflation is actually net beneficial to revenue and earnings if it doesn't upend overall spending trends. So if we look at respondents expecting higher versus lower stock prices in the next 12 months, this is that Consumer Conference Board survey we talked about. That's the record high. Now, the reason that I wanted to include this chart again is because it juxtaposes against the lower chart the number of participants expecting lower rates in the next 12 months. Now, central banks around the world have promised us lower rates globally. With few exceptions, central banks are cutting rates. And so just about everyone expects rates to be materially lower during the year ahead. After all, it's been broadcast to us. Why wouldn't we expect that? Well, the concern could be that yes, we get a rate cutting cycle, but it's not quite as strong as expected, because there are signs that inflation is coming back, that some of the raw aggregates of input pricing are starting to push higher. And that's led to over half of countries seeing year over year CPI rise in the last month. So again, we're seeing just some signs that inflation could reaccelerate. Now, that is something that could put a damper on some of the current market leadership, but it could also lead to a bit of a transition that could be beneficial to other parts of the market. Another area to pay close attention to for the inflation tail risk is China. Really, all eyes on China, and to some degree what happens with central bank rate cuts and fiscal policy here in the United States. But China has been the largest contributor to global money supply for quite a long time, basically since the great financial crisis. If they start to stimulate in size and they really get their economy going, their consumer starts to participate again, we start to see more demand for energy and raw materials, that would be the tail, right? That would be something that could feed into inflation, because at that point, you're really starting to fire up the world's second largest economy that's a pretty large consumer of just about everything they can get their hands on. So again, it's conditional if this plays out. It's not a sure thing, but there are areas we can watch to get a sense as to whether the odds of this scenario playing out are increasing. And one would be China, and whether they stimulate aggressively to lift up domestic consumption. That would be the key. And that's something they've talked about kind of keeping on the sidelines as they discuss the tariffs and the potential for a trade war with the upcoming Trump administration. So we'll watch, and I'll continue to provide my thoughts on it as we go through those motions. And speaking of rate cuts, Bank of America is forecasting 124 rate cuts by global central banks in 2025. So we can see why so many people in that survey are expecting lower rates. We've been told to expect lower rates. It could be one of the most aggressive cutting years in decades. But on the other side of that, the risk to that is that if inflation does perk up, central banks are not going to feel like they have the same amount of slack to be able to cut interest rates. So it's just something to take into consideration. Now let's shift back to US markets and in particular how they are pricing compared to Europe. This is a pretty incredible chart I shared. It went kind of viral earlier. And the reason that I shared it was just to pose a question, a bit tongue in cheek, but are we heading into an environment where maybe someday there will be some kind of mean reversion, or is this just the new normal? Is Europe toast and they're just never going to be able to claw back? I am more leaning towards toast because I think that the markets over there are sort of regulated to death, and that also the European Union as an economic construct is somewhat flawed, having a monetary union without a fiscal or budgetary union. And these are not countries that are going to have a top-down political regime. So there's some structural issues here. But nevertheless, this is pretty incredible because it's really just never been this level of outperformance. And some of that outperformance is driven by incredible levels of market concentration as well. The top 10 stocks in the S&P 500 have been amazing growers for the most part. Few exceptions, maybe Apple and Tesla in there. But overall, these stocks' earnings and revenue growth have been unprecedented. And so it's led to a lot of multiple expansion, a lot of front running the anticipation of future growth, and that same growth is starting to slow a little bit. So valuations are expensive in some of these, growth is starting to slow in many of them, gives us a sense that in those areas of the market, it's not a bad time to lighten up a bit and look for other opportunities. And we see other investors that have been around just a little bit longer than we have, taking a somewhat similar tactical approach. Buffett loading up on cash, really all-time high cash as a percentage of total assets. So this isn't just cash in aggregate or nominal terms. This is cash total AUM. So Buffett is very long cash here, and you can't blame him. He's getting a pretty good yield on that cash. He's been buying a lot of bills, but at the end of the day, he's also had a pretty good track record getting out of some of these larger de-risking events that can happen. And I think it's more coincident. I think it's more him just saying, okay, this is just too expensive for me to want to own. And so he gets out of the way, and then inevitably, eventually, maybe you have some kind of correction or bear market or otherwise. So I'm not saying that's what necessarily has to come yet, but I do think it's very interesting because you see evidence of cash just being a preferred asset. Money market funds up to $6.6 trillion, a new all-time high in November. And SODs, another area of concentrated global wealth, surging T-bill exposure over there. Again, folks looking for places to park cash because they're not necessarily wanting to put them in longer duration income or in risk assets. Speaking of risks and opportunities, let's talk a little bit more about the latter, because this is where I think things could go from here, where there are some opportunities for the rest of this year and going into next. One, small and mid caps, which have been outperforming the S&P 500 and the NASDAQ since the start of the fourth quarter. This is an area where they are objectively, in many cases, more attractive. Now, I don't like the Russell 2000 growth component, so I don't really want any exposure to that. I like IWN rather than IWO, so we'll talk about that in a chart in just a little bit here. But I do like greater mid-cap exposure in aggregate. Mid-caps actually tend to outperform the S&P over time. And there's a lot of reasons for that, but basically, if you think about it, these are small caps that are graduating. They made it. They're ready. They're continuing to grow as companies, and often they're either going to continue growing or be acquired, but the mid caps tend to outperform. They tend to be higher quality companies, much less risk than the Russell, which is full of unprofitable, lower quality companies, especially in the growth factor. So let's look at some of these. This is QQQE. This is the NASDAQ Equal Weighted Index. I like this because we're seeing highs breaking out versus lows in tech. So I think QQQE could outperform QQQ here. Doesn't mean it has to be a long, short trade. I think just exposure to QQQE in of itself is a decent area, and just managing risk with the 50-day moving average you get a day that closes below that, it's probably a good idea to close that swing position out because momentum is not nearly as favorable in that situation. Now adapt it to your trading system and your model and your risk management, but that's how I'm looking at that one. Then we also have RSP. This has been an idea that I've been talking about since summer, and you can really see it started to really shake out some of that weakness and then rally hard from summer. So I like RSP even here. Wouldn't mind seeing it settle back down, maybe even a retest of the 50 hold and bounce. But this was one that I would look for to buy on weakness, provided that that momentum is still intact to the upside. The next one is MDY. That's your Spider S&P Midcap 400 ETF. Just like RSP, looking for a little bit of a pullback, but I'd love to buy this thing on a retest of the 20 or 50 and then a bounce. I think then you've got some of the weak hands shaken out. You're still in that uptrend and you've got validation from some of the bigger hands buying it up. Then there's IWM. This is the Russell Small Cap Value ETF. So less risk in the balance sheet. Many of these companies have free cash flow. You're not looking at the same kind of dilution risk because they're not just running on debt and fumes. And again, wouldn't mind seeing a bit of a pullback here, but this is one that I would also want to buy in a pullback with continuation. Then there's XLE, the energy ETF. It's gotten a bit beaten up over the last several trading days. This one is a buy, but I'd like to kind of accumulate in nibbles over the next several months. This is not a play that I want to look for like a big pop higher soon. This is a longer term swing play that I would look for in the quarters to come because energy companies have become more productive. They're able to extract more oil with less operators per rig. They've got much more sophisticated technology, so they're able to extract more oil per well. There's just a lot of things going on. The energy industry has actually gained productivity faster than any other industry in the S&P 500. So there's a lot that could add to margin expansion, even if we have a somewhat challenging year. All bets are off if oil really starts to plunge into the low 60s and hold there. But otherwise, I like XLE. And there's XLI Industrials. I would like to see it come back, kiss the 50 and get bid up again. But this is one that I would look at buying because if we start to see prices coming up again, if we start to see more global economic expansion, XLI is a beneficiary of that. It's a very cyclical area of the market to gain exposure to. Then there's Hack, the cybersecurity ETF. This is one where I'd be comfortable also nibbling over the next quarter or so as a longer term swing because cybersecurity is becoming a very important part of business spend. It's becoming mandatory. So these companies are becoming more like utilities with growth. That is to say, you've got mandatory customers. The amount of customers they have are only growing over time. And that has to do with mandates from governments, from their clients and otherwise really starting to drive it, as well as a worsening cybersecurity picture globally. I mean, I'm sure every day you look at the news, there's a new data breach. Well, that's definitely helping to drive more folks into spending money to prevent attacks and to respond to them. Then we've got gold. And I think if gold can make a push above the 50-day on a closing basis, I want to get long this and look for it to hit 3,000 in the first half of 2025. That's been my basis. We're just looking for momentum to set up this next leg of the swing. So we got the move that I was looking for in September. That was really that 2,700 move. Now we're looking for the next leg of this rally to 3,000 from just around current prices, just a close above the 50. And I think this one is another decent one to look at, managing risk with that same 50-day moving average. And we have silver. Silver looks like it wants to put in a bottom, but like with gold, I do want to see this one push above the 50 and hold there. Then I would manage risk with the same. But if we do get that push higher and we put in a sort of nice, strong reversal off these lows, I think silver could start to push back into the mid-30s. So to recap, opportunities I'm watching. I'm also very interested in DBA, the agriculture ETF. I didn't have a chart for that one today, but that is one that's breaking out. If it settles and reverses higher, that's another one. But there's the cybersecurity ETF Hack, energy, the XLE ETF, the equal weight NASDAQ QQQE, the equal weight S&P 500 RSP, gold and silver or GLD and SLV, industrial XLI, mid caps MDY, and small cap value. We will wrap it here. Appreciate everyone tuning in. I'll I'll catch you soon.